Hello, my dear future chartered accountants. Good evening to all of you. I hope my voice is audible and the PPT is visible. Can you please confirm it? Yes. So I hope you are finding consolidation comfortable. A quick 2-minute recap. Consolidation is about process of holding company plus subsidiary company is equal to group books, and that process we prepare the working note format. Essentially we will have 3 columns: goodwill within brackets, PL, other equity, NCI. Then broadly from subsidiary company, share capital and the reserve items are used for computing the net assets in the date of acquisition. So pre-acquisition element goes to goodwill calculation, post-acquisition element goes to PL calculation. Either of the cases, whole outside shares will go to NCI, and investment from subsidiary, investment in subsidiary from holding company is taken from the holding company books and is subtracted under holding company books. So we are discussing various adjustments. Let's do this problem now. So come to this problem now. Summarize balance sheet of PN Limited and SR Limited on 31st March 2018.
Problem number 48
are as follows. Hope you got the question. PN, SR, examination problem. Given land and building, plant and machinery, investments, inventories, trade receivables, cash and cash equivalents, equity share capital, other reserves, retained earnings, trade payables, short-term borrowings. So retained earnings, we will take it like P&L. Generally what we used to do in problems. Other reserves is like general reserve, what we used to do in problems. PN Limited acquired 70% shares of 100 each of SR Limited on 1st of October 2017. The middle of the year, exact middle of the year. The retained earnings of SR Limited showed a credit balance of 93,600 on 1st of April, out of which a dividend of 12% was paid on 15 December 2017. Very good. PN Limited has credited the dividend received to its retained earnings. Fair value of plant and machinery of SR Limited on 1st October 2017 was 6,24,000. The rate of depreciation on the plant and machinery was 10%. Following are the increase on comparison of fair value as per respective IND AS with the book value on 1st of October 2017 of SR Limited, which are to be considered while consolidating the balance sheets. Land and building, inventories, trade payables. Inventory is still unsold on the balance sheet and trade payables are not yet settled. Other reserves on 31st March 18 are same as on 1st of April. The business activities of both the company are not seasonal in nature, and therefore it can be assumed that the profits are earned evenly throughout the year. Prepare the consolidated balance sheet on 31st March 2018 of the group of entities of PN Limited and SR Limited as per IND AS. Okay, so this was the exam problem. I think May 2019 problem. Let's read the problem once more. reserves and P&L, other reserves and retained earnings of subsidiary company as on the date of consolidation. So we have 3,12,000 other reserves, general reserve, 2,55,800 retained earnings. And they have given retained earnings showed a credit balance of 93,600. So they have given the opening balance of retained earnings. What about reserves? Retained earnings showed a credit balance, out of which they pay dividend. Dividend credit to retained earnings. What about reserves? Other reserves, any information? They said other reserves were same as on 1st of April 2017, which means there is no addition that took place during the year. So whatever the other reserves you are seeing, 3,12,200 is itself the opening balance also. So 3,12,000 other reserves is also opening balance on 1/4/2017. No addition took place. So current year 0. And retained earnings given 2,55,800. And what we should do before we do any other further calculation? We have to add back the dividends, correct? So dividend need to be added back. So let's go back to the dividend information. Dividend at the rate of 12% was paid. So 12% on share capital of 6,24,000. 12% on 6,24,000. That comes to 74,880. You add, then you get the opening balance information. They have given in the problem 93,600. So balancing figure becomes current year amount 2,37,080. Divide this into two parts because acquisition took place at the middle of the year. Up to the date of acquisition becomes pre. After the date of acquisition becomes post. So 6 months, 1st of October. They also gave a clarification telling it is now seasonal in nature. So you accrued evenly throughout the year, and that is a regular assumption anyway we make. Under any cases, we make the same assumption. So up to 1st of October, 6 months into 6/12, and after 1st of October, again 6/12. So what will be the nature? This 3,12,000 is going to be pre opening balance. This 93,600 again opening balance is pre. This 1,18,540 up to date of acquisition is going to be pre, and this 1,18,540 after date of acquisition is going to be post. No, I mean this is post, correct? I wrote it only. It's going to be post. After date of acquisition is going to be post. First write down till here, then we'll go further. If you have any doubts, please ask. Let's discuss the revaluation aspect now. fair value adjustment related to the plant and machinery of SR Limited on 1st of October was 6,24,000. Rate of depreciation is 10%. So they only have given this is the revalued amount, fair value, revalued amount. But they have not given the book value. You know how we used to calculate the book value? We start from the opening balance, provide depreciation till the date of acquisition. But in this problem, opening balance also not given. So what do you do? What do you think we can do? Are you able to understand what I'm telling? You don't have information about opening balance also. Normally what we used to do, opening balance was there. From the opening balance, you provide depreciation and you provide you count the WD on date of acquisition. So what we have to do, in the balance sheet what they have given is after depreciation. And again we make an assumption, there are no purchases and there are no sales. So the closing balance is same as opening balance except for depreciation. Rate of depreciation is given, so we'll work backwards and compute what is supposed to be the opening balance. We'll do that. Okay, so fair value adjustments on plant and machinery. Regular format heading will write down first. Plant and machinery, subsidiary books, subsidiary. Then group books. Then difference. Now what plant and machinery amount we have in the balance sheets? Plant and machinery in the subsidiary company SR Limited, plant and machinery, we have 4,21,200. Now this is after depreciation. So if I do calculation, 100 rupee is the opening balance. Depreciation they said 10%. Closing balance becomes 90% and this represents 90%. So 4,21,200 is 90%. How much for 100%? So we are going to calculate by 4,21,200 into 100 by 90. This is going to be the amount on 1/4/2017. Reverse calculation. That is 4,68,000. Okay. Then we provide depreciation. Depreciation for 6 months. So on 4,68,000 into 10% into 6 by 12. $23,400. So WDV on 1st of October 17, 4,44,600 and revalued at, what is the fair value taken? 6,24,000. So difference will come to 1,79,400. Difference is 1,79,400, which is going to be the fair value adjustment. And whenever this comes, what we should provide? Depreciation. So let's provide less depreciation for 6 months. This will remain same only, 23,400, that will not change. But as per books, as per group books, it will change. We have to provide on 6,24,000 into 10% into 6 by 12, you get 31,200. So what is difference in depreciation? Additional depreciation comes to 7,800. Is the number correct? Additional depreciation 7,800. The amounts are correct. Instead of writing one below, you can do too many adjustments are there. We'll do it here itself. So other fair value adjustment, everything put together, I will give as one calculation. You can show separately, but I will prefer to show it as one calculation. Fine. So let's do it here. So fair value adjustment of plant and machinery we have done. Okay, so I'll just do other fair value adjustments also. I'll say overall fair value adjustment. Individual items, let me just say rupees, let me show you the list. So on plant and machinery, the fair value adjustment we just calculate 1,79,400. We have on others also. Land and building also there is a fair value adjustments. Inventory is also there. Trade payables also there. So these are all, we'll take it as upward valuations. Where I say increase, upward valuations. Now land and building also, when there is upward valuation, we should provide depreciation. Correct? Just like what we have provided for plant and machinery. But the problem here is, for land and building, we don't have opening balance information. We don't have depreciation information. So any assumption you make, you will not be able to calculate the impact of depreciation. Either opening balance is required or rate of depreciation is required. One of them is there, we can find out the other and we'll try to compute the WDV as a date of acquisition and depreciation for the subsequent period. But for land and building, except the balance sheet value, we don't have depreciation information, we don't have opening balance information. So depreciation impact on land and building cannot be calculated. We'll just take the value as it is. That is 3,12,000. Okay, so land and building 3,12,000. Then inventory is also there. Stock 46,800. Then trade payables is there, but trade payables, remember, has to be subtracted. fair value adjustment, trade payable has to be subtracted. 31,200. That will give you net fair value adjustment. This we will take it in our working notes. So what is the net fair value adjustments? How much it comes to? Five lakh 7,000. Right? So this net amount, one amount only. Give me 1 second. Just do this one line. So we have SR Limited, subsidiary company. They only have given 70%. Start from share capital 6,24,000. 70% goes to goodwill. NCI 30%. Okay, next. Other reserves, opening balance only, entire is free, current year nothing. Retained earnings, opening balance we have, and current year we divide into two parts, pre and post, up to 1st of October, after 1st of October. Pre comes in goodwill column, post comes in conpl column, outside shares anyway comes in NCA column. Okay. Then what are the adjustments we have to do? Fair value adjustment is pending. Let's do fair value adjustment 5,07,000. Net amount you can take it. Goodwill column, NCI column. Okay, fair value adjustment 5,07,000. Depreciation only related to we have plant and machinery. That's all we'll make use of it, and that is going to be post acquisition element. Fair value adjustment is pre, goes to goodwill column. Depreciation is post, goes to CONPL column. Dividend paid 74,880 will come in CONPL column, NCI column. They said it is out of opening balance and all, does not matter. Which year it is related to does not matter. It is received, you add in P&L, and here you subtract. No other change. They have not told any fair value of NCI, so we don't have to do that adjustment. You can come to the holding company details. Other reserves, retained earnings. Again, remember this dividend, we don't add it here. Their dividend received by the holding company is included in their retained earnings. That is why we are subtracting here so that amount gets eliminated. So no need to add this amount in retained earnings column. One of the common mistakes. So I'm sharing it with you. So please do the total. See if you're able to get the answers. I hope there are no new adjustments here. Everything is straightforward, but still, these are the kind of question you can expect in examination. So it is done. How much goodwill you are getting? Negative goodwill. So it should be goodwill, negative number. See if you are able to get these amounts. Goodwill 89,402, CONPL 11,39,502, and NCI 507,300. See if you are able to get these numbers. And let me know if you have any difference or any doubts. Okay, let us do that note on PPE once, then we go to the balance sheets, because quite a few things are there. So let's do whatever the particulars. Okay, let us not only note on PPE. We in this problem we also have other fair value adjustments, like land building. There is an adjustment for unrealized, for inventory. There is an adjustment. Correct. So let me do, let's say, notes to balance sheets. One by one we'll show it. First we'll show it on PPE. Like that we'll show one below the another. So holding company, subsidiary, any adjustments you do, then net. Okay, so heading under that you can say PP. Below that we will be having land and plant and machinery first, let's say. Holding company plant and machinery. Holding company plant and machinery. Okay, 7,48,800. Subsidiary 4,21,200. Adjustments, we have computed depreciation and fair value adjustments. Fair value adjustment 179,400, and depreciation to be subtracted 7,800. So how much that amount comes to? $13,41,600. Hope the amount is correct. 13,41,600. Okay, land and building 4,68,000, 5,61,600. No adjustment, or adjustment is there. Fair value adjustment is there. $41,600. Any other assets? Nothing else. So we can do the total. 26 lakh 83,200. lakh 83,200. Okay, so this is PP. Let's do other notes also. Like there are some adjustments for inventory, 3,74,400. Subsidiary company, 1,13,600, and there is fair value adjustments of 46,800. 46,800. Because it is unsold. This 46,800 because the inventory is unsold. So whatever fair value adjustment was there relating to inventory is coming even in the balance sheet. There we added, here also we add. So journal entry basically is like stock account debit to the net assets, whatever the calculation which we are doing, which will affect goodwill earlier. Anyway, so what is the discussion? I will just repeat once more. Fair value adjustments like on inventory should be taken in two places. One place, it will come in fair value adjustment as a part of pre-acquisition profits, as a part of net assets on the date of acquisition. Second adjustments depends on whether the inventories are sold or inventories are unsold. The simplest adjustments what exam can give, which is what they have given, is unsold. So if it is unsold, it should come in the balance sheet, which is what we are doing now. But if it is sold during the year, then what would be the impact? Remember, what would be the impact if the inventories are sold during the year? If the inventories are sold during the year, reduce in working note, where? Reduce in working note, where? Balance sheet, where? I think we need to give we should write a note in sentences. I think you don't remember, you would have forgotten. Check the charts, maybe you can refer the charts. Fair value adjustments. If unsold, how it is to be treated. If it is sold, how it is to be treated. Unrealized profit. No, we are not talking about unrealized profit. Unrealized profit is on stock sale between holding company, subsidiary company. We are not talking about URP. It's not about unrealized profits. Inventory is sold. Reduce in goodwill column and NCI column. We have to reduce in Con-PL column and NCI, not just Con-PL. Con-PL column and NCI column. Okay, let me explain you the logic. If you want, you can take it on once more. This adjustment has not come in the exam, so you can learn from this. Okay, focus on this. Okay, so as per subsidiary company books, suppose stock value on the date of acquisition is, let's say, 80,000. Please don't think some amount, it's a random number. 80,000 subsidiary company. And in the group books, it is valued at 1 lakh. So that's what the difference. You would have taken 20,000 as a fair value adjustment. Fair value adjustment. Like in this amount case, 46,800. Only difference was given. We have taken a difference. And subsequently, If it is unsold, like in this problem, nothing to worry, this 20,000 will come in the balance sheet as a stock, which is what we have taken here. So one adjustment while computing fair value, second adjustment as part of inventories. Fair value adjustment relating to inventories. Now subsequently, after the date of acquisition, this is an example, please don't forget forget, you can mention somewhere, it's an example illustration. Subsequently, if it is sold after the date of acquisition, subsequently post acquisition, after the date of acquisition, post, suppose let's say they sold for let's say they sold for 1,05,000. So in subsidiary company also you show sold for 1,05,000. In group books also you show 1,05,000 because sales is same only. So in subsidiary company when you sell, how much profits you are going to show as per P&L account? 25,000. And as per group books, where will you show how much profit you show? 5,000. 5,000. Now this 25,000 would be included where? This would be included in subsidiary company P&L. Subsidiary company P&L. And to be more specific, is it pre or post? In our analysis of profits, it is after date of acquisition. So it is post acquisition profit, and we should not consider separately. When we consider subsidiary company P&L post, it is already included in that. If it was sold during the year, the subsidiary company P&L already includes. Subsidiary company P&L post includes 25,000. Includes 25,000. No need to add separately. But as per books, how much it was supposed to show? As per books calculation, it was supposed to show only 5,000 because the group made profits of 5,000 only. Because the cost for the group is 1 lakh. The sale value for the group is 1,05,000. So 5,000 is the profit for the group, but we would have shown 25,000. So 20,000 excess profit already included now need to be eliminated. So this excess profit of 20,000, this difference, excess profit of 20,000, excess profit of 20,000 to be eliminated. And what is this excess 20,000 profit? That's what is fair value adjustment. Another way of understanding, 1,05,000 is the sale price, 80,000 is the cost, but the group when they acquired 1 lakh, 20,000 profit was already considered. Fair value adjustment upwards, part of net assets, 20,000 profit was already considered at the time of acquisition as a means of fair value adjustments including net assets. Hope you are able to get this. The profit, what is shown as fair value adjustments during our calculation as a part of net assets on the date of acquisition, that fair value adjustment represents the profit already recognized. Now when you sell the asset, you cannot recognize that again once more, but subsidiary company had not recognized it, therefore they have recognized, but group should not recognize full profit. The group should recognize only excess profit, that is over and above that 20,000 profit, but they would have recognized 25,000 as a part of subsidiary company P&L account, which need to be reversed. So if you include 20 there also fair value adjustment and include 25,000, total profit becomes 45,000, needs to be eliminated. So this is again duplication, like dividend adjustment. This is also duplication in P&L. Duplication in P&L to be reversed. And how do we reverse? Holding company share we subtract in CONPL, outsider share we subtract in NCI. So in a way, for very raw purpose, very raw remembering purpose, not concept, raw remembering purpose, crude method. The treatment what you do for dividend, what do? You subtract in CONPL, subtract in NCI. Exact same treatment you give for this profit if the inventories are sold. The logic is very similar overall, because we are eliminating what is already recognized, but in which place is slightly different. Because for holding company P&L account, so subsidiary company's dividend would have been included, dividend received. So that 2-time dividend received to be eliminated, we subtract. Here the profit on stock sold by the subsidiary company would have been already recognized to the extent of fair value adjustments. That is a duplication to be eliminated. We don't touch goodwill column. We don't touch goodwill column. Even for dividend, we subtract in CONPL, we subtract in NCI. Please have a look at this chart once more. 1 second. If I want, I'll just put that chart once more. Okay, please take a look at this one. This chart must be there in the material, please confirm. Fair value on the date of acquisition. Adjustment. It can be land and building, plant and machinery, inventory, payables, etc. On the date of acquisition, the difference between fair value, book value, holding company share goes to goodwill column, outsider share goes to NCI. Then the adjustments we have to do on the date of consolidation. If it is unsettled, unsold, which is the case in the problem what we are doing now, we adjust in the balance sheet value, means inventory, plant and machinery, land building, everything we add. If subsequently sold, even you can say depreciation is also in a way like that only. I mean, mathematically, we subtract in CONPL, we subtract NCI depreciation, part of fair value adjustment attributable to that. Anyway, so if the inventory on which you did fair value adjustment is sold subsequently, the fair value adjustment will be reversed, because to that extent it is already recognized. Where is it already recognized? It is already recognized as a part of fair value adjustments. Now subsidiary company would have included again in their P&L account, which is duplication. If you want, you can update this chart. Why? Because subsidiary company P&L would include this profit, which was already recognized by group, which was already recognized by group as fair value adjustment. This sold, the fair value difference adjustment profit, it would, the subsidiary company P&L would include this profit, fair value adjustment, which was already recognized by the group as fair value adjustment on the date of acquisition. So now that's a duplication. So duplication need to be reversed. So that duplication recognition profit to be reversed. The duplication to be avoided, to be adjusted. So if it is sold, we reverse, the duplication is reversed. In which column? In the profits of the subsidiary company, which we would have taken into in our calculation. We would have taken to holding company share in CONPL, would have taken to NCI share in NCI, outside share in NCI. Please take a look at this chart once more and let me know if you have any doubts in this regards. Or if you want a note on anything, let me know. I'll dictate in words. If you require any particular note, let me know. Because this chart should be sufficient, but still, if you have any doubt, you can let me know. Are you clear? Should you want some more time? Any doubts on this one? Hope you got the chart. You had a look at it, because day before exam, the chart is what you are going to revise. Ideally, you should not solve any problem on consolidation freaking out day before exam, 2 days before exam. FR, the first paper, is going to have a lot of impact, the confidence level in your examination. So we take it here. If it was sold, this amount will come in Con-PL column, NCI column. Hope you are clear in that regard. So what the total amount comes to? Please tell me the total of this one. Five lakh 34,800. Is that correct? Five lakh 34,800. Okay, so trade receivables, adjustments was there. Nothing, no, sorry, trade receivable, no. Trade payables you had. Okay, we'll write trade receivables. When it comes over, let's give that note also. What is there? Trade receivables, 1,86,500. 1,24,800, no adjustments, and net amount comes to 3,11,300. Cash and cash equivalents also will give. If you want, you can give notes like this in exam. Cash and cash equivalents. 45,200. 24,900, 70,100. No, 24,900. Okay, 70,100. Then we have trade payables. Trade payables we have adjustments. 1,46,900, 34,300. Adjustment, trade payables, adjustments, 31,200. Again, why 31,200? This is unsettled, yet to be paid. Unsettled, yet to be paid. Yet to be paid. Now, please tell me this one. If it was settled, what you would have done the other adjustment? Instead of taking in this column, where you would have taken? If it was settled, where you would have taken? If the trade payable was settled, you would have taken Con-PL NCI. Correct. You would have taken proportionately Con-PL NCI. Would you have subtracted or would you have added? Very good. It is added. Correct. Added. The inventory unrealized profit at 46,800 was a profit recognized earlier. Now that profit recognized earlier, we have to remove. So earlier plus, now we do minus. But trade payables increased, means it's a loss. So we have recognized this payment already. We have recognized this loss already. We should not recognize this loss once more. So in Con-PL we need to add, in NCI we need to add. So what point to be kept in mind? If the fair value adjustment was negative, then while reversing at the time of settlement, it will be added in Con-PL column, NCI column. If it was plus, like inventory plus, fair value adjustment is a profit, then subsequently at the time of settlement in CONPL it's subtracted and it is subtracted in NCI. Please write a note on that one, otherwise you'll forget. Please write a note on that one. No? For items such as inventories, trade payables, etc. For items such as inventories, trade payables, for items such as inventories, trade payables, etc. For inventories, trade payables, etc. Inventories, trade payables, etc. If fair value adjustment was profits, if fair value adjustment was profits, if fair value adjustment was profit, if fair value adjustment was profit, then it is subtracted in CONPL and NCI. It is subtracted in CONPL and NCI upon sale or settlement. It is subtracted in CONPL and NCI upon sale or settlement. Upon sale or settlement. Upon sale or settlement. Next line, if fair value adjustment was a loss, if fair value adjustment was a loss, if fair value adjustment was a loss, it will be added in CONPL and NCI. It will be added in CONPL and NCI. In CONPL and NCI upon sale or settlement. Upon sale or settlement. Upon sale or settlement. Upon sale or settlement. We have short-term borrowings are there, that also will write down. Short-term borrowings. Like 49,600, 20,000, 2,69,600. Okay. So everything required we have discussed. Even the notes required for balance sheet also we have discussed. Simple formality of preparing format in the balance sheet and put the numbers. So please prepare the balance sheet. Okay, let's see if you're able to prepare the balance sheets. Okay, check your numbers. PP we have done, intangible assets we have done, inventories we have done, everything note has been given, including the liability side also we have it. We have done the notes. So I don't think here you should do any mistake. Even here if you do mistake, you should be great only. But anyway, just compare your answers. Okay. If you are trying to do balance sheet total verification, even all the fair value adjustment should be considered. If you are doing the verification method, yeah, all the fair value adjustment of everything we taken in the column, we should consider. In the sense, you should take all these things. We should take fair value adjustments and depreciation and above. So fair value adjustment, you take it as 5,07,000. Everything will be considered there itself. Dividend you don't take it if you are doing verification. Okay, you can try again later, no problem. Okay, we'll not be able to start fresh problem now. We'll take a break now. Take a break of 10 minutes. We'll meet after that. Take a break of 10 minutes. Summarize balance are as follows.
Problem number 51.